All right, well, good morning, everyone. It seems we've got a bunch of our clients here ready for this webinar. We appreciate you joining us. Joining me today is our firm's principal, Joanne May.
Hello, everyone. Thanks for attending.
And one little quick housekeeping thing is if you go to the top right-hand corner of your window, you click on speaker view. That way, whoever's speaking, the camera will be on them. But you're not here to listen to Joanne or I today, besides our questions and comments. But we are joined today by Vice President at Dimensional Fund Advisors, Apollo Lupescu. He's our colleague, he's our friend. Many of you are very familiar with him. He is phenomenal at explaining complex topics in a very clear and concise way. So welcome, Apollo.
Great to see you, Tyler. Hi, Joanne. Thank you so much for the
Hi, Paul.
the invitation to be part of this webinar again. I'm always looking forward to these conversations.
Absolutely. Well, thank you for joining us. A little bit different here in Chicago versus where you are today. -2 degrees in Chicago. I think you guys have a high today of 60. Our high is of, I think, 3 degrees.
I know, and we're just talking. I just came back from New York last night, and New York was not as cold as you, but boy, like very different than here. But on the other hand, you guys don't have the traffic, the smog, the taxes, a lot of things that are trade-offs to this nice 60-degree weather, which just seems cold right now to me, but it's balmy to everybody else in the world.
You got it.
Exactly. Well, we wanted to start off today by just talking about 2025 in review, right? There was a lot of things happening both domestically and abroad. It's just crazy with all the headlines popping up over the news. To name a few, we had a new administration come in, the announcement of tariffs in late Q1, early Q2 of 2025. We had the longest government shutdown. We had the Fed cutting rates, and then geopolitically, I mean, Iran, Venezuela, Israel, Greenland.
Yeah.
So we can get into that more later on, the geopolitics, but we're really looking forward to hearing what you have to say about 2025.
Yeah, so 2025, as you said, there's so much that happened, and ultimately the question is, how did we do as investors? And I have to say, one of the things that I've come to appreciate doing these events with you is that you really customize any investment portfolio because you want to make sure that it fits the profile of the family and in terms of their needs, the circumstances, the risk capacity. And because of that, what I can tell you folks is that most likely the performance that you would see on your own statement is likely than other participants on this call. And one of the main reasons is because if you look at the two main components of a portfolio, they're really driven by either buying ownership in companies, and that's what stocks give you, or by lending money to corporations and governments through these bonds. So if you look at 2025, what's really interesting is that when you look at stocks, that portion of the portfolio comprehensively across all the stocks that you own was up roughly about 22% or so if you look at the MSCI index, which is a global market metric around the world. And that's, from my understanding, that's what Forest does. It's a very comprehensive global approach. And if you look at the bonds, again, it was a variety of bonds, but generally speaking, what you see is that roughly about a 4 or 5% growth on the money in bonds. And that's exactly what we expect. We do expect that stocks deliver higher returns, better performance than bonds. Bonds also tend to be a little bit less choppy in the long-term performance, so they don't fluctuate in value as much. So the great news to report, folks, is that last year it was fantastic. The long-term average in the market's about 10%, and if you look at these two numbers, I mean, first of all, 22% more than twice the long-term average, and even bonds did very, very well. So what you would see on your own statement really depends on the balance that you have between stocks and bonds. If you're more heavily leaning towards stocks because of your own personal circumstances, your needs, your risk capacity, then you'd be closer to 22%. If you're more conservative, closer to retirement, you probably have more in bonds, and you'd be closer to 5%. So I think it's really custom, but by and large, really good news to report. Now, this 22% that you see in stocks, I do have to say that as I said, it's a global approach to investing. So within stocks, the largest component comes from U.S. companies, U.S. stocks. And there are roughly about 3,000 of them. And if you look at that, you can say that, the market metric was roughly about 17% among these 3,000 stocks. Uh, but the other two categories of stocks, one is what's called international developed markets. And international developed markets are, Japan, Australia, UK, and so forth. The countries that we know that have good economies and solid legal systems. And what's remarkable is that international developed last year, the countries that had these foreign markets went up by a remarkable 32%, 32% up in the MSCI Developed Markets Index. And you look at emerging markets, which tends to be the smallest piece of a portfolio in terms of percentage. Those countries also remarkably were up about 33%. So really good news just pretty much around the world. And what's even more interesting is the international developed and emerging markets doing even better than the US, despite having the tariffs and all the things to contend with. And if you look within these international developed, just remarkable. The best performing international developed markets happen to be Spain, and Spain was up about 80%, 80% up the Spanish stock market. You got Austria about 78. And if you go down and you say, well, what are they not very well performing? Well, the second last worst performer happened to be Australia. And what's even more remarkable that Australia, being the second worst, was still better than the US, was about 18%. And we did have one negative international developed markets, and that was Denmark. And for folks who are not familiar, the Danish is not all about Greenland. They also have this company called Novo Nordisk, which makes Wegovy and Ozempic and all these drugs that we've come to appreciate, legal drugs that a lot of people use these days. And they were the negative 8% or so. But I do want to start there because there was a lot that was made last year about tariffs and the fact that we're going to impose tariffs, and that's going to harm perhaps other economies, other stock markets. And let's take maybe a bit of a deeper look. If you look at the U.S., roughly about 17% up. And the one country that we imposed probably the steepest tariffs, at some point they were 145%. It's almost like, a bit of a joke is that 145% tariff, that's a very big tariff. And that country was China. And if you look at the performance of the Chinese stock market last year when they got all these tariffs against them, and everything seems to be stacked against, well, they did not go up by 17% like the US market. In fact, they went up by 31.5%, significantly more than the US market, despite being the subject of tariffs. We also have been really picking fights with our neighbors to north and Canadians, and again, they had a lot of products they're exported to the U.S., and that didn't seem to be very good for the Canadian economy. And yet, the Canadian stock market did twice as well, more than twice as well as the U.S. market, despite all these. And then our friends to the south, the Mexican neighbors, their stock market was also up significantly more than the U.S. So I think what's really remarkable is, I think one of the big stories here is that one ought not to get carried away with a simple narrative. Oh, tariffs are good or bad, and that should make me move money from one place to another, because there are too many other variables, too many other factors that drive the performance of these markets. And trying to simplify the whole thing into one, it's just not the most productive way. So again, great news to report, but also cautionary tale. If you think that something is so intuitive, makes so much sense, you got to be careful because they might not always pan out. So in
Paolo,
the U, yes,
can I just put something
yeah,
in context for you?
absolutely.
So most of our clients have about 30 to 40% of their stock portfolio in international. So
That's
let's
great.
say, yeah, let's say it was 40%. Of that 40%, about 10% would be emerging. So it's about a 75-25 split there. So
That's great.
Just to put it in context, what our clients are experiencing.
I appreciate
So
that.
I give them lots of kudos for staying the course and keeping our allocations pretty steady, whether they're 30 or 40%. Um, anyway, just wanted to throw that out there
No,
so
and I
you.
appreciate because I don't know exact the percentages, but it's good to
Mhm.
know because I know that when we had an event not too long ago, we're talking about international, and international had not done as well as the U.S. And one of the things that you and Tyler and I advocated, like it's good to stay disciplined and diversified and not give up just because a particular part of the world didn't do as well. And last year certainly was a good way to reinforce that worked. It's
Mhm.
exactly what we have been talking about. And talk about also diversification, even within the U.S. I mean, if you go back to the beginning of last year when tariffs came about, and you looked at the S&P 500, the U.S. market, boy, it was not good. It was down about 4%, and so much anxiety about where we're going, economy, inflation, perhaps recession, and yet second quarter was really good. We recovered because the tariffs didn't get implemented the way we thought we would. And then Q3 was also positive and Q4 was positive. So for folks who did not get carried away with the emotions of the first quarter, ended up being a really solid year in the S&P 500. It was up about 17.9. And what I think it's also fascinating, Joanne and Tyler, is that if you look at these 500 stocks, about a third of them actually lost value and about two-thirds increased in value. So not every stock in the market went up or down, but the ratio was for every stock that went down, about two of them went up. So it's a good year. And some of these stocks completely unpredictable, which one's going to be in the positive or negative. And just to give you an idea, if you look at Walmart and Costco, both great retailers, big box stores. It turns out that Walmart was positive, Costco was negative. You look at Verizon versus T-Mobile. I mean, T-Mobile was negative, Verizon was positive. And probably the ultimate example is Pepsi versus Coke. Pepsi was up about Pepsi was up. Well, actually, Pepsi was down and Coke was up. So it was a great year for the market for the S&P 500. And as we talked before, the way we measure performance is not only by looking at the individual results of a stock, but to come up from 500 different performance numbers to just one, you also have to account for the size of the company. The larger the company, the greater the emphasis that we put on that particular stock. And this is why these Magnificent Seven not only are important because they have a nickname together, but also because they're some of the largest stocks in the market. So when the market was up about 18% or so, if you take these seven stocks aside, what you see is that on average between the seven of them, they were up about 22.7%. So quite significantly more. And if you look at the hole they left in the S&P 500 minus these seven, the S&P 493, those were also up, but a much more modest 15.3. So somehow, the Magnificent Seven are able to add sorry, about 2.5% to the performance of the market, even though there are only seven stocks. And the reason for that is because together they amount to roughly about 35% or so of the value of the entire S&P. And that's quite a bit. A third of the S&P is in the Max 7. And then you also have NASDAQ with exactly the same seven stocks, but instead of 35%, they are at 54%, so quite a bit more. That's very concentrated. More than half of NASDAQ is in seven stocks, so that's quite a bit. And in a global allocation, like Joanne outlined, you would not miss out on them. That's very important to know. You do not miss out on them, except that instead of putting more than half the money in these Max 7 as the NASDAQ, in a global allocation, they would be combined about 19%. So you just basically have 12,000 stocks around these Max 7, and because of that, their percentage is lower, which doesn't mean you miss out on them. It's there. I think there's a benefit of what if they don't do well, then you do have these other ones to hold you up. And this year, again, international emerging really did fantastic, both better than the Magnificent Seven. So there was great news for folks who stayed disciplined and diversified. But the one other quick note, I was curious, obviously the past 2 or 3 years, we've seen these Mag 7 driving the market. And we talked about the Mag 7 and then the S&P 493, the rest of the stocks in the S&P. And if you look over not just the last 2 or 3 years, but look over the past decade, the remaining stocks in the S&P went up by about 200%. So over the entire period, they went up about 200%. So it's kind of nice growth that we saw in the U.S. market without the Max 7. But what's also very interesting is that when you look at the Max 7 over the same time frame, they didn't go up by 200%, but rather a whopping 999%. Almost 1,000%. So it's a remarkable difference between the Mag 7 and the rest of the market. And the story here is that we've had a great run on these large stocks over the past 10 years, which you've seen in the past, that these magnificent seven, these large companies, they do continue to grow. It's just that the cautionary tale is that when we've looked at the data, once a company becomes so large and dominant, looking ahead over the next few years, 3, 5 years, we don't see as investors the same great results as they've had over the previous decade, particularly as they get bigger and bigger and bigger. So the thing is, that's great. The Mag 7 have, driven the market to some degree. They've helped it propel to new highs. The rest of the market in the S&P, it's it fine, but nothing and as well as the Mag 7. But the cautionary tale is that, maybe this is a really important that we're not overdoing it on these Max 7 because past performance does not repeat. That's not just the slogan. That's actually the truth.
Very interesting. I actually just read in the Wall Street, I think it was yesterday, that the Mag 7 is really diverging, and some
Right.
of them are still doing well, but where others aren't.
Yep.
So we'll see what 2026 brings.
Yeah, we'll see. I mean, you're not going to miss out on them in this global
Mhm.
portfolio. You're not missing
Mhm.
out. You might not see each stock listed on your statement, but they are part of the funds that you hold. So it's not about the name of the fund, the box. It's what's in the box that matters, and you do have exposure to them. And I think the great news is that the way that Forest Asset builds your portfolios, you're not exposed to that concentration risk like a Nasdaq. But also be
Right.
mindful, by design, they're not trying to deliver the performance of Nasdaq. So if in any particular period you see Nasdaq doing something different than your portfolio, it's exactly what I would expect because you don't have more than half the money in seven stocks. So don't be like, "Ooh, what went wrong because I didn't match Nasdaq." That's by design.
One interesting thing that you mentioned is, well, Dimensional puts out these amazing one pagers that we provide our clients. And if you look back from 2004 up until 2024, Denmark, which actually lost, was -2 last year, they, on an annualized return basis from 2004 until 2024, they actually out earned the United States. So that is
That's
very,
true.
very interesting. But I do like what you just talked about in terms of valuations, specifically about the Magnificent Seven. And I think that's a great segue into talking
Right.
about valuations because the last time that we spoke, you mentioned that you think that people understand what the word is, but maybe not the very definition of what valuations mean for stocks. So if you could shed some light on that, that'd be great.
Yeah, so let's talk about valuation because it's a bit of a jargon and I think it's worth explaining what exactly is valuation. And valuation is the concept, the idea that you want to see for the price that I pay, what do I get? And if you buy a house, it's the price per square foot. So you can say, well, I know the valuation of that house because one sells for $300 a square foot, the other one is $600 a square foot. So that's the idea of valuation. How much are you paying for a unit of something that he can measure? In the case of house, it would be a square foot. So it's not about the how much are you paying for the house because obviously you have a house that's twice as big. That's not easy to compare unless you compare per unit. So in the case of stocks, how do you do that per square foot? What's the idea? And the way that investors do it is by looking at the price and then comparing with some accounting fundamental for each share of ownership that he can measure today. So let's make it real. When you go buy a share of a company, any company out there, you now partake into that business ownership. I could not buy ownership in Forest Asset unless Tyler and Joanne said, "Yeah, you're welcome to come in," or maybe you're not welcome to come in. But they decided this. Now, companies that are listed on stock exchanges, they have opened up the ownership to the public at large. All of us can go buy ownership in McDonald's and all the companies that we know and love. Now, the thing is that when you buy that ownership, you're not buying hope. You're buying something very, very precise. You get to partake into the profits and the earnings that the company makes, like any business owner. So if I had a restaurant and I'm the only owner, I take home all the profits. If I actually bring in my brother-in-law and then he owns half and owns half, then he takes half the profits, I take half. It's exactly the same idea with a stock. So let's take a look at Tesla. So if you look at Tesla, if you buy one share of ownership at the beginning of this year, it cost about $450. So what do you get for that? Well, you get taken to the earnings of Tesla, pretty much like Elon Musk. Not as much as him, but he certainly can partake in those earnings. So earnings is the easiest way to look at it. It's like, okay, well, if I were to own a piece, what would be the earnings associated with my one single share of ownership? And it turns out that for 2025, the earnings per share in 2025 associated with one share in Tesla were roughly $1.50, a buck 50. So the way to think about valuation is I just spent $450 that I could have bought a jacket, I could have had a nice dinner somewhere. But instead of doing that, I bought one share of ownership. And for that share of ownership, Tesla theoretically comes and puts a buck 50 into my piggy bank every year at the current rate of earnings. So here's a question of the valuation, the way that I framed it in my own mind. If if I spend 450 bucks and at the current rate of a buck 50 per year, Tesla comes and put that money into my piggy bank. At this current rate, how many years would it take for me to make my money back and then be ahead of the game? So I spend 450, I get a buck 50 per year. The math is not super complicated. It's about 300 years before I recoup my initial investment and I can be ahead of the game. So it seems to me that that's a fairly high price that I'm paying for what I get today. And then you can compare, well, what if instead of buying the Magnificent Seven hype and all that, you go buy the good old stodgy Toyota? No AI, no electric, just hybrids and gasoline. It turns out at the beginning of the year, the price was roughly about 215. And the earnings per share were roughly about 20 or so. Let's just say 20 to make it easy. So it was roughly about a 10-year payback for Toyota. So when I look at this and I look at the valuation and I can look and say, well, which seems like a better value today? Which one seems more reasonably priced? Well, certainly a lot of people say Toyota because it gives me 20 bucks and it's half the price of Tesla. So that's what valuations are trying to do. And the technical name for this break-even period that I call, it's actually price earnings. So if you hear this P ratio or price earnings, it's just simply looking and saying, hey, how many years before you break even at the current rate of earnings? And that's kind of what we're seeing today is that the long-term average price earnings in the U.S. market is about in the 20s. It's in the 20s, somewhere in the 20s, depending on the period they look at. But let's just say in the 20s. Now, let's look at the Magnificent Seven, Tyler, because you asked about them. If you look at the Magnificent Seven, Tesla is certainly an outlier with a very, very high price earnings. So the higher the number, the more expensive, in plain English, this company would be to buy today. And then if you look at the other ones, the only one that is kind of in the ballpark of the long-term average is Facebook, and the parent company of Facebook is called Meta. And everybody else, you have these Apple, Microsoft, Amazon, they're all in the 30 plus. And Nvidia is actually even more expensive in the 40s. So it is interesting to see that these Magnificent Seven, maybe leaving out Facebook, they tend to be much higher than the long-term market in the 20s, and among the seven of them, the average is roughly around 68 for the price earnings ratio. And the remaining of the stocks, and this is where it gets so interesting, the remaining stocks in the S&P, the S&P 493, their price earnings is a lot closer to the long-term average. So it doesn't appear that all stocks in the S&P are so richly valued. There are a handful, particularly the Magnificent Seven, they're well above the average, but a lot of the other stocks are pretty much in line with the long-term average. And then outside of the Magnificent Seven, we talked about 3,000 companies in the US. Well, the S&P is only the largest 500. If you look at the other ones, they were called small caps or smaller companies. Their price earning is actually below the long-term average, which a lot of people would say, well, that's a good deal. And within small, there's a category called small value, and that valuation is even lower at about 12. I think what's interesting is to acknowledge, Tyler, that there are some stocks that are very richly valued, and particularly the Magnificent Seven. Their valuations are very high compared to long-term averages. On the other hand, you do have a lot of other stocks in the S&P 500. They're very close to long-term average. And in the US market, this might be a really good time to make sure that you have some small cap exposure, you have some value exposure because those valuations are even lower. So not every stock is so highly priced, and you have to be a little careful not to overdo it with these very highly priced stocks, which kind of goes back to the same point that we make. Own the Mag 7 just in case they continue to do amazingly well. Just don't overdo it, just in case. Just be cautious of that.
Can I do a follow-up question to
Yeah.
that? And maybe, I hope this isn't unfair because it's asking you about different stats. How would you compare the US average PE ratio to the rest of the world, whether it's
Yeah.
developed or emerging?
Yeah, historically these ratios have been higher in the U.S. and I think what's interesting is again the impact that the Mag 7 have had on the U.S. averages because the Mag 7 are such a large portion of the S&P is that if you look at the S&P as a whole, it might seem high relative to international developed and emerging markets. And on the other hand, you know, if you take those Mag 7 out, then it's a lot. It's much more reasonable for the U.S. market. But the U.S. market has had an amazing run over the past 10 years or so. A lot of it on the back of these Max 7. And because their prices in the U.S. have moved tremendously higher, but not necessarily in international markets as well, that's causing the P ratio in the U.S. to be a little bit higher. Now, there's one other quick thing because I do want to mention this, and it kind of ties into your question, Joanne. When I showed you these numbers and I said, you know, 450 for the earnings about 50, the obvious question might be, why would anybody buy Tesla? It just seems foolish. You know, it's going to take 300 years for you to just get your money back. And the only explanation that makes sense is that people expect that the earnings of Tesla are going to shoot through the roof. That just you wait until they, you know, clean up their self-driving and they start doing AI and so forth. So these price earnings, these very high valuations for U.S. companies are a reflection of the expectations that AI will bring great fortunes to these companies. And these fortunes might not be realized today, but we see the potential of them making so much money down the road. So we're going to price it in today, even before these earnings come. A lot of internationally developed and emerging, like a Toyota and so forth, they don't necessarily have that because you know Toyota's pretty, you know, like in terms of cars, I don't see Toyota just busting it out. I mean, you know, when you sell software, you can sell the same thing to a million people without costing you a penny more. Whereas scaling automobiles and manufacturing other things is not as robust as it is scaling AI or software. So to me, I think that the fact that these price earnings are high in the US is you look at the Max 7, but you also have to look at a lot of these companies right now that are very richly priced are reflecting the opportunity that AI might bring to the table. And even though they're not there yet in terms of making the money, we know that this could actually realize, and if they do hit the jackpot, it's going to be a gusher coming your way.
Right, but it goes both ways, right? These rich valuations, right? They have this expectation built in.
Exactly.
If they don't meet those expectations, that's when
Exactly
we
right.
see a huge decline.
Exactly
If
right.
it's Tesla or any of the others, and that adds to the certainly adds a lot to the risk, of course, and the volatility, et cetera. So just points another reason why you don't want to just own them, even though they've been high flyers in the past. You're
Exactly right.
buying, yeah,
You got it. You
exactly.
have to have the other ones as well, just in case,
Mhm.
as you said, if these don't pan out, this is not
Mhm.
going to be pretty. But if it pans out, great. It's going to be milk and honey. But you don't know
Mhm.
at this point. We don't know. So you need to hold
Mhm.
them and you need to hold the other ones just in case.
Right, exactly. Okay, makes a lot of sense.
I love how you tied in price to earnings ratio with valuations as well as diversification, which obviously we're always preaching to our clients, but also that it's so important to have exposure to US small and US small value, and the importance of Joanne and I making sure that we're constantly rebalancing our clients' portfolios when you have the growth of the Mag 7 to make sure that our clients are staying within their risk tolerance. But you mentioned artificial intelligence, and that is probably the number one headline dominating 2026 right now. So I
Right.
was wondering if you could go into artificial intelligence and perhaps compare this revolutionary technology to a recent revolutionary technology.
Yeah, and to begin with, I don't know if Tyler and Joanne, if you're playing with AI, and I mean, I've just been toying on my own personal, just for fun, just to see writing poems, whatever, creating funny pictures. But it's been interesting to see that this is a pretty revolutionary technology. I mean, just at a personal level, this is fun to play with. It's great, and if you have not done it yet, I think it's something that you ought to experiment with because it's certainly that's where the puck is going. I mean, there's no doubt in my mind that that's sort of like it's going to impact our lives in many ways, and the more comfortable you are, probably the better off. And what's also very interesting is that when you have a technology like this, a revolutionary technology like this, it is quite possible that the biggest beneficiaries of this technology might not necessarily be the creators. If you think of a supermarket scanner, and you think, well, who benefits more from that technology? The company making the scanner or the supermarket itself? In other words, is it the creator or the user of the technology that might benefit more? And then you're going to have logistics companies, you're going to have financial firms, you're going to have retail, you're going to have restaurants who might actually benefit more from the technology than the creators themselves. So one additional argument about why you ought to stay diversified and not just focus on AI, even if it sounds like that's a future. Be careful with that. You still need to have companies around the world. But you mentioned this idea of revolutionary technology, and to your point, the last time that I saw this magical thing happening in my life was in the 90s with the internet. When that came about, it was clearly a sense that this will change things. It will impact so many things, jobs and the way we do commerce and a lot of things. And what's fascinating, if you go back to that time, and which is also applicable today, the reality is that you could not invest in the internet as an entity. You couldn't say, I want to invest in in the internet, but rather there are different horses in this race. There are different companies who were using the internet. And at the time, and particularly when in this race, it's not obvious who the winners will be. It's not obvious at all. And because you cannot invest as a monolith, you kind of have to either pick some horses if you want to do them or just kind of get them all. But what I caution is that if you go back to the 90s and you just say, okay, well, let's say some websites from the 90s, and again, take yourself in a time machine, not with what you know today, but just how the world was back then, and all of a sudden you see some websites, and one website is selling toys, and one website is selling books, and one website is selling pet supplies. And if you were to somebody ask you, okay, which one of these do you think will become the future of internet retail? Was it obvious that a bookseller is going to become the biggest internet reseller? No, it was not at all. So the idea is that I think that as an investor, you have to accept that in order for you to have Amazon, you also need to hold pets.com and eToys. You have to accept that. And if you simply focus on the fact that, oh, eToys and Pets.com, they went out of business, that was the bubble. What you're missing is that Amazon became Amazon. You missed the fact that for the companies that disappeared, you had Google that emerged, which changed the world. You have Netflix that changed entertainment. You have eBay. You have Facebook, which is part of all these are Mag 7 stocks, some of the largest, most successful companies in the world ever, and they came from the internet age. And if you simply focus on, oh, but Pets.com went out of business, you missed the point. The point is that when you are in this race, it's not obvious who the winners are, and you have to accept that some companies are going to go out of business, and that's okay because the companies that survive, the companies that make it, unknown at the time, but the companies who do are more they're going to make up for all the other ones that don't. That's exactly what happened in the internet age. So to me, if you say it was a bubble, what are you talking about? The internet exceeded wildest expectations. You look at the companies today, they are in the Max 7. Amazon, Google, Facebook, they all emerged out of the internet age. So you missed the point that we don't know which companies will make it. But the big thing to know as an investor is that this is not really unusual or just atypical. If you go to any venture capital in Silicon Valley, I mean, they've talked about this forever, and you have funds like Benchmark and Founders Fund and Andreessen Horowitz, all of these will tell you the same thing. We're going to fund 10 companies knowing that six of them are going to burn through cash, produce nothing, go out of business. One or two are going to chug along, maybe get acquired, and one or two are the moonshots they're going to make up for everybody else. And I think what's really remarkable is that at the moment, this private equity, this venture logic is permeating into the public markets because investors are confronted with the same idea today. Is that, listen, you cannot invest in AI as a monolith. There are all these horses in the race, and the reality is that nobody knows who's going to come out ahead. We're just in the early stages of this race. So you kind of have to put money knowing that some of these AI companies are going to burn through billions of dollars, create nothing, go out of business. That's par for the course. That's exactly what I would expect to happen. And that's not a definition of a bubble to me, because it's very logical knowing that the companies that emerge out of that are going to be incredibly, incredibly successful. And what's even more interesting is that this logic is not limited only to new technologies. If you look at the US stock market going back 100 years and you look at the totality of stocks, all the stocks in the market, on average about 3,000 companies at the beginning of a cycle, for example, what you see is that over this 20-year cycle, roughly about 60% of the companies just disappear. Only 40% of the stocks survive a 20-year period, which is roughly the same as with these venture funds, which is nuts. And within these stocks that survive, only 18% of them actually outperform the market. Those are the moonshots. Those are the ones that generate the extra performance. And boy, do I wish I knew which stocks had these 18% and just put money into them. The reality is that it's not any more obvious that a bookseller would be the future rather than toys or pet supplies. So because of that, I don't think that anybody should be surprised if some of these companies are going to disappear, maybe go out of business. And if there is a lesson too, going to the internet era, is that people talked about, oh, we build over capacity and we build all the fiber and then nobody fiber cables and nobody used them. Well, the reality is that they didn't use it for a minute, but then they became the base of the internet as we know today. And even all these investments that AI companies are making in computer centers and so forth, well, they're not burning money. They're putting computers. And if they're not going to be used for AIs, trust me, somebody will find a good use for them down the road. So again, I'm not at all convinced that a bubble even exists to begin with, because right now there's an amazing opportunity for the companies who make it. And they might not be the first to market. My first social post was, I think it was on MySpace. I used Alta Vista and Yahoo well before Google. But the companies who do emerge victorious out of this, they're going to print money. That's what Google's doing. That's what Facebook's doing. That's what Microsoft and that's what I should focus on, is those companies, rather than, oh, pets.com went away. I think it's short-sighted to do that.
I remember Apollo 19, the early 90s when I was wondering, what is this World Wide Web?
Yeah,
And the companies that were in the paper a lot were, I don't know why I remember this, but Netscape, iOmega,
that's
I,
right.
and well, I don't know what happened to Netscape. I think it might be around still, but iOmega is certainly gone. And there were so many
Alta
others.
Vista. You remember Alta
All those
Vista?
all the ones that had interesting names, it's the ones I remember. We
Yeah.
do have a question that came in from the audience, and it is, what are your thoughts around the energy use to power these AI companies?
Yeah.
I
And
don't,
that's
I don't know
actually
if
a,
you,
yeah, it's a very interesting question. And I think it has multiple facets to it. And one facet is the social aspect, which is that a lot of these energy companies are utilities that are regulated by governments, and they've been able over the years to really balance the infrastructure and the investments they make with what is expected to be consumed by businesses, by households, and so forth. And they've done a fairly decent job of doing that. And now you're putting this in the ring, and all of a sudden, like, wait, if you need so much more electricity, I have to build the capacity. And what they're afraid of is like, well, if I build this capacity, build it, but what if they don't come? What if some of these data centers might not actually end up working out? Well, I'm stuck with repaying the loans that I used to build this infrastructure. So I think that in some parts of the country, they're very careful about how do we let this. I think citizens, consumers are concerned that, are you going to draw too much power that we might have rolling blackouts for us, for our houses? So I think there is a social element to this that involves investments and the use of electricity. I think there is another side to it, which is that companies like Amazon and Facebook and Microsoft and Google, all of them realize that this is an issue, and some of them are actually getting into this business, and they're buying companies that create electricity, or they are investing in nuclear
interesting.
companies that can deliver maybe a unit the size of a VW bus, the little minivan that they had, and
Mhm.
that unit can power an entire center and kind of be off grid. So these companies that are going to use the data centers, they're trying to find ways to be self-reliant, and they're investing. I think Google bought an energy company specifically for that. So they're kind of like
Wow.
taking it off the grid. So it is an issue. In some ways, it presents an opportunity. Last year, a lot of these energy companies, particularly the smaller ones, had a banner year because there's a
Mhm.
huge demand, but it might not be from the utilities as we've known them. It's quite possible that those the data centers users, they're going to say, I want to control this myself. So why
Mhm.
can I build something that is more
Mhm.
local, that I don't have to worry about other things? So it could be natural gas, it could be a lot of other things. But I think that it's a little early to tell, but for sure, both the utilities and these data center companies, they're paying attention to this, and they're trying to find a solution. So I do think that soon enough, this is not going to be necessarily a big issue. At the moment, it
Mhm.
seems like it is, but this is my personal belief. They'll figure it out, and it might be
Mhm.
that they have to create their own power, and they'll figure out how to do that.
Mhm. Okay,
All right, thank you for
thanks.
that, Apollo.
Mhm.
Prior to the meeting, we asked some of our clients to reach out with any questions, and we saw a common theme. And you spoke to it a little bit earlier as to the great run of U.S. domestic stocks over the last 10 years, particularly over the last three. I think a lot of investors and a lot of our clients, whether they're worried about recent returns or maybe geopolitical issues. They're waiting for the other shoe to drop. And if history shows us anything, we know that we are due for a market correction or another downturn. And I think that you do a really good job of looking at the scope of history and explaining what a market downturn is. And I think that's a great way to end this meeting.
Yeah,
Let me respect all your
absolutely.
time.
Absolutely, because I think, listen, folks, I mean, we talked about LA. I mean, I live in LA. It's not just about the 60-degree weather. I mean, the other big trade-off of living in LA is that I'm under no illusion that I will live my entire life without seeing an earthquake. And there are going to be different types of quakes, some bigger ones, smaller ones, but I know they're coming. Now, that knowledge of the earthquake coming is pretty much irrelevant because I don't know when. I also need to know when they're coming. And that's the problem. In the market, you have something very similar. You have these little shakes and bigger shakes. It's just that they come in unpredictable times. What you have to make sure you first of all you understand what to expect, and second, prepare for those. So in order to know what to expect, well, let's look at market downturns and how often they happen and what to expect from them. And when you take a deeper look, what you realize is that there is not one single type of market downturn. There are different types of market downturns depending on their severity. And if you listen to the media, quite often you would hear the word correction. The market is in a correction. The market's a correction. What is a correction? Typically, a correction means that the stock market drops by roughly about 10%. So it's not a huge drop, and I call this the baby cub, the bear cub. It's like it's a tiny cub, and it's like a 10%. And in my lifetime, I'm born in 1969, there have been 28 of these corrections. So on average, every 2 years, we see a correction. And because they happen quite often, we get a little bit desensitized to them. So they're not a big deal. And that's the most often type of market downturn, the correction. We see it quite often. The market tends to rebound. We forget about it quickly until the next one happens. Now, every once in a while, there's a more severe downturn that's called a real bear market. So there's a real bear market, and that is when the market drops by about 20%. And if you look at the US S&P 500 index, in my lifetime, there have been roughly about eight of these bear markets. So on average of every 7 years. And because they don't happen that often, and there's more severe, they draw a lot more attention. So that's where people kind of, whoa, we're in a bear market, not good. Just to let you know, in my lifetime, eight of them, every 7 years or so, you should expect a one of these bear markets. Just to know, there's nothing really nutty about this. It's exactly what I would expect this to happen. And then once again, the market rebounds. Now, what's even more interesting is that every once in a while in my lifetime, and also in my 20 plus years, 25 years of experience as an investor, there are certain types of market downturns that are even more severe and they're more lasting because they hit a nerve with investors. And I think that those are, again, they're even more severe than the bear market. So I couldn't find a term for that. What is a really severe market downturn? So in my mind, well, what's bigger than a bear? A grizzly bear. So in my mind, every once in a while, there are some grizzly bear markets, and those are a 30% or more downturns. And these are very severe. These are something that really impact. They give us PTSD. They're really something to contend with. And in my lifetime, there are only three. There was a 73, 74. There was a 2000 dot-com bust, and it was a 2008 great financial crisis. So on average, those happen, every 18 years or so. And again, I'm not at all predicting that I have no idea when the next one's going to come. Between 73 and 2000, there are 20 years. Between 2000 and '08 was only 8 years or so. So it's not really clean. That's the average. But what I can tell you, the last time that we had a big market downturn like a grizzly bear was in 2007, 2008. So it's been quite a few years, and what I thought about this is that when I go to the beach, sometimes I forget to put sunblock and I get really sunburned. Well, boy, after that, I keep putting sunblock like there's no tomorrow. Until some time passes by, I was like, "What sunblock? Well, I don't need it until I get burned again." So, in other words, we want to remind ourselves, what does it actually mean to be in this grisly bear market so we can manage the emotions at the time when this would come. It's going to come. I have no idea if it's the next 6 months, 6 years, or 10 years. Nobody can tell you. But what I think we can do is this little fire drill of knowing what to expect when that happens and not feel like it's the end of the world. Well, we've seen those before. So let's take the first one. It was a 73, 74, and that was driven by a variety of factors. We had the oil crisis. We had President Nixon resigning. We had the dollar not being connected to gold. We went off the gold standard. So a lot of things that drove that 73, 74 downturn. And if you look at how severe was that downturn in 73, 74, if you paid attention to the news, and you were at December of 1972, and you asked the question, well, how long would it take for the stock market on the news, the S&P 500, to come back to the same level as it was on December 31st, 1972? Sort of the shocking answer is it did not reach the same level until July of 1980. 91 months. That's 7.5 years when you would have been on the water. That's a very long time. Very, very, very long time. And again, month after month, year after year, kind of go back. I'm still on the water. I'm still on the water. So it can be a very long ride that is on the water. And that's why people are so afraid of this. And the question that becomes, okay, is how do you prepare for something like this? What do you do to mitigate both the severity and the length of this downturn? And the first thing to note, folks, is that what you see on the news is something called price only, meaning that to measure the performance of the market, you just look at the price of the underlying stocks and you determine the value of the S&P, which makes sense, except that these companies are also paying you dividends. In other words, when they make money, some of the profits that they make, they distribute to shareholders as dividends, and those in the market on the news reporting are just not considered. They're like they don't exist. They just like you take them, you eat them, you do whatever you them, but they don't exist. So the first thing is, what if you just simply take these dividends that the companies are paying and you just reinvest them in the market? That's all you do is just reinvest the dividends. Will that make a difference? So if you were to do this, what's remarkable that if you simply reinvest the dividends and nothing else, instead of 91 months, you would have been, back to black in less than half the time, 42 months. By 76, you would have broken even. So the first thing that you can do is continue to reinvest even when the market is down, and you're likely going to come way, way ahead of the market on the news, which does not actually include the dividends. So that's the first thing that he can do. The second thing that he can do is realize, as we talked about today, is that this is the S&P on the news is simply a metric of the large companies. But what he could do is include some smaller companies. We talked about this, and Tyler mentioned them as well. You can include some international companies, and Joanne talked about this, and he can balance everything with some bonds. And if you create this kind of the stereotypical, prototypical, hypothetical 60-40, you name it, the question is, how will that benefit? So not just reinvest dividends, but also be more diversified than the S&P. Will that make a difference? So let's take 73, 74. 73, 74, there were 91 months. And during the 91 months, the lowest point, the maximum drawdown was 46%. You would have lost 46% of the money. Now, if you have this globally diversified balanced allocation with reinvesting dividends, the first thing you notice that instead of 91 months, you would break even again in 37. In about 3 years, you'd be back in black. But the second thing that's remarkable is instead of a 46% maximum drawdown, you would only have a 26%. So both the severity of the drawdown and the length can be mitigated by using other investments rather than just what you see on the news. And that's the first one. The second one was the dot-com bust. And if you look at the dot-com bust, it lasted 81 months before you broke even. And at the worst, it was, again, pretty much identical 46% maximum drawdown. if you employ the same strategy, what you see is that instead of 81, it half that time, about 40 months, and the maximum drawdown was a much more manageable 20% rather than 46%. So very interesting how you can mitigate both the severity and the maximum drawdown. And the last one was the Great Financial Crisis. And over the time frame, 65 months. So that was, over 5 years, almost 5.5 years to recoup the losses. The maximum drawdown was actually more severe at 53%, more than half the money. And now, again, if you use this strategy, instead of 60 months, it would have been 38 months. And instead of 53, it would have been 33% maximum drawdown. So I think that what's really interesting is that if you look at these grizzly bear markets, whether it's 73, 74, 2000, the dot-com bust, and the GFC, in every single case, if you are more diversified than the market on the news, if you're balancing this with some bonds, in every case, the time to recovery and the maximum drawdown is mitigated. That doesn't mean you will not lose money. That's not what I'm saying. What I'm saying is that both the severity of the maximum drawdown and the time to recovery are significantly better with this. And if you have a financial plan, I'm quite confident that if you have the financial plan and you need money over the next 3 or 4 years, that this financial plan will do it in a way that you can recover without having to sell at the worst time. And to me, it basically says that if you say I don't have 10 years to recover, the question is, do you have roughly about 3 years or so? Because even in the grizzly bear markets, in 3 to 4 years at the most, we saw these losses coming back and being ahead of the game. So they're not pretty. Now, I'm not going to suggest they're pretty. It's just that once you get a perspective that there is something we can do, I should also manage my expectation that this is not going to blow over in a minute. It's not the first time. Then you're more likely to navigate those times and be at peace and have some mental comfort knowing that I understand and I know this is coming. I just need to be prepared, and I have an advisor who has a plan for me.
Paulo, there's so many things that you just said that we could spend another hour talking about, but I know we're coming to close. One thing I just want to mention is that dividend reinvestment idea.
Yep.
Having something automated that hits to the psychology of investing as well, because it is very difficult to put new money. People
Yep.
call it throwing good money at bad when the market's going down, but that's exactly what you should be doing and what we do it automatically through dividend reinvestments. I also saw it in play during 2008 for my clients that were in 401k plans that
Yep.
were systematically investing every 2 weeks, even though the market was down 40%.
Yep.
So they came back in less than half the time as the rest of the market because of that. So there's so many things to unpack here, and we don't have the time, but I just had to mention that's super important. And that's why we have the philosophy we have about rebalancing and selling high, buying low, that sort of thing.
Yep.
So Ty, do you want to add anything before we wrap up?
No, just wanted to say thank you very much, Apollo. I love that we do these annually. It's amazing how much new content can come up within a year. We're very, very appreciative with our relationship with you and Dimensional. So thank you very much for your time. I know all of our clients really appreciate it.